welcome to the InterAxis channel and interaxis.io. We want to talk today about crypto and insurance, and not the way we've talked about in the past, where we talked about how DeFi or decentralized finance is going to create these insurance products, these kind of pooled risk products that are going to reward some of those that are creating the pools and be able to provide this insurance for those that have previously not been able to obtain insurance. This is talking about some insurance that's already out there and where we see crypto partly as collateral. So first, we want to remind you, if you're watching this on YouTube, please subscribe. We love that. We want to be able to give you more content. Follow us on Twitter at InterAxis8. If you're not understanding what you're seeing here, we have an academy to help you understand Bitcoin, blockchain, crypto, how to invest, what it means, how to do DeFi, all of that. Please go visit us on the academy. Now, back to crypto and insurance. And the reason why we wanted to talk about this today is because we saw where Liberty Mutual and some other companies, of course, in the past, Mass Mutual and New York Life, have invested in NYDIG, invested in basically in crypto infrastructure, in the ability to custody assets, transact in crypto assets and digital assets, and why this could potentially be so important and where we could see this in the insurance industry, again, why it's so important. First, we want to talk about in the past when these mutual companies, Liberty Mutual, New York Life, Mass Mutual, why it's so impressive that, of course, Mass Mutual bought Bitcoin specifically, but why they're investing in this infrastructure is because it is very important to them to back the infrastructure, because I'm quite certain they want to hold some of these assets. And what do I mean by that? When you're a mutual insurance company, that means you're owned by your policy holders. Mass Mutual, New York Life, Liberty Mutual, they don't have stockholders. They have policy holders who are owners of the company by virtue of the fact that they own a policy. That means they are very limited. These mutual insurance companies are very limited in how they can invest the pool of money that they have that is reserved for future benefits. Okay, what I mean by that is, if I have in this case, a life insurance policy, and I'm only 46 years old, and I might live till 90, what Mass Mutual has to ascertain is, what is the likelihood I'm going to die any place in here, and if so, they're going to have to give $1 million to my beneficiaries, to my wife. Okay, and they need to plan all that out. But in so doing, they have this pool of money that they need to invest in a way that they can get to at any time to pay out benefits, to pay out death benefits to all the people they have insured. But they have to invest so much of this money and they have to be very risk averse. There are rules that say how much can be in risky assets and how much can be in relatively risk-free assets. And as we know, relatively risk-free right now is paying virtually nothing. So it's very hard for them to find yield, but they have to account somewhat for inflation, right? They also have to account for being able to pay things out over time, to the fact that at some point in the future they'll have to start paying out benefits. And that's why it's so important when Mass Mutual started buying Bitcoin, when these insurance companies, these mutuals, are investing in the infrastructure, because what will most likely happen from that is they feel comfortable being able to invest in Bitcoin or invest in crypto to hedge some of that inflation risk, to be willing to take on some of that Bitcoin or take on some of that risk, that volatility risk, because they're getting virtually no yield in the bond market, which is where most of their investment lies. They have to be able to take some risk, and they want to feel comfortable with it. So that is a kind of a really important point. I don't know if that's exactly why they're investing in it, but that's a key point. Another thing to keep in mind is, in the insurance world, is something I was just talking about with someone, something called Surety. If you don't really understand what Surety is, especially in the construction world, is if I have a construction company called Adamco, okay, and I'm doing a project for Ronco, so I'm building the project, and it's, say, a $10 million project here. Ronco, whether Ron is a company, especially if this is some sort of municipality, some sort of government type entity, they're going to require that I go get a surety bond. And a surety bond basically is a payment bond. It means that I'm going to go out and get this $10 million surety that says that if I don't complete the job that I said I was going to do, this surety will pay Ronco some money so that they can go find someone else to complete the job. Okay. What it also says that I am going to hire subcontractors, right? Because I might be the general contractor. I'm going to go hire subcontractors. And if they do the work and I don't pay them for some reason, they can go to the surety and they can get paid. They have to file a claim a certain way and they can go get paid. Okay, so the surety company, which is an insurance company, is going to write this. And what they're going to do is they're going to make sure that I have a certain amount of cash. Okay, so I might have, for $10 million, I might have to have $2 million of cash, of cash and cash equivalents sitting around. And based on my time in the business and based on my performance history and everything, that's the multiplier effect I get. So if I've been in the business a while and have a really good track record of finishing jobs and paying subs, and the surety has really never had to come to my rescue, I might get a 5x or a 10x multiple. If I'm brand new in the business, I might only get a 1 or a 2. So in order to get bigger jobs, I have to put up more cash, and my cash just has to sit there. Whether it's in my company or me personally, it just has to sit there. And any financial advisor knows when you go to a construction company and you see all this cash on the books, your eyes get wide and you go, man, I can help you manage that. And then the construction company goes, but you can't, because I need this cash sitting around so the surety can see it, and then they can write me the surety bonds, because with this $2 million cash, I can go get a $10 million job. Now, all that to say, imagine if the sureties were comfortable enough with the infrastructure and comfortable enough with Bitcoin and crypto to tell me I no longer have to keep $2 million in cash. I can keep $1 million in cash and $1 million in Bitcoin, because they feel comfortable that I could lock that up in some sort of wallet here, that if I don't pay, that if I don't fulfill what I'm supposed to do, or I don't pay my subs, now they're going to go pay them, and they're going to take my cash and my Bitcoin, and they feel comfortable enough with it. Now imagine that as the construction company, not only do I get the surety that I wanted, but in this, I get to potentially offset inflation. I get a store of value that I didn't have before, because cash and cash equivalents do not include shares of stock. They don't include equities or anything. But if companies like Liberty Mutual and Mass Mutual, New York Life, Mass and New York Life, by the way, do not offer surety bonds. But if insurance companies are getting comfortable with the infrastructure and getting comfortable with the custody of crypto and comfortable with Bitcoin, then maybe this is on the horizon. Maybe there's a time when construction companies like this can actually have digital assets, and it doesn't have to be Bitcoin. It could be some other digital asset, some other store of value that they could lock in a smart contract or something. But again, if these insurance companies are on the boards and invested in a custody or an infrastructure play like NYDIG, they feel comfortable with it and they can help build around it. Now you see a future where real companies, construction companies doing real jobs, are now able to utilize crypto assets, utilize digital assets as both an inflation hedge and something that can be used for surety. That is potentially on the horizon. I don't know if that'll happen, but that's a potential, and something I got really excited about when I read this article about how Liberty Mutual and other insurance companies invested in the latest round of NYDIG. So I just wanted to get that out there, how important it is that insurance companies are jumping in and seeing the value of crypto, seeing the value of Bitcoin, cryptocurrency, digital assets, especially the ability to custody the infrastructure, the ability to hold them, and what they can represent for those insurance companies now and down the road. So wanted to talk about that. Hope you'll subscribe. Hope you'll visit the Academy, interaccessacademy.com. Follow us on Twitter @interaccess8, and we'll see you in the next video.